Foreign investors are exiting the Indian stock market very quickly. In fact, by mid of May itself, 27,048 crores worth of shares has exited Indian markets. In April, another 60,847 crores has exited Indian markets. This is one of the biggest foreign sell-offs India has seen in recent years. In fact, in first 4 months itself, the foreign outflows has crossed a staggering 2.2 lakh crores, surpassing the total selling pressure of entire 2025. Foreign investors has aggressively trimmed their holdings in heavy sectors like IT and banking and dropping their total foreign ownership in NSE listed companies to near 15%. It is a historical 15-year low. Historically, whenever foreign funds has panicked like this, the Nifty and Sensex would completely crumble. But today, the market is not crashing, it is fighting back. Who is secretly observing this massive global shockwave? The real surprise, it is not big billionaires. Despite massive foreign selling, Nifty 50 has remained resilient. Indian markets did not completely crash. Retail panic selling has been limited. Corrections have stayed relatively controlled. So, who is buying everything that FIIs are selling? The answer is domestic institutional investors, the real heroes of the market. Domestic institutional investors, they include mutual funds, insurance companies, pension funds, EPFOs, Indian banks, and SIP investors. These institutions are now absorbing the enormous foreign selling pressure. Reports show that DIIs has injected nearly 1.7 lakh crores to 2.5 lakh crores into Indian equity market during the major phases of 2026 selling. This is why market survived. The biggest Indian financial revolution has come. The biggest hidden force is not the billionaires, it is ordinary Indian investors. The SIP money, systematic investment plans. Monthly SIP inflows are now estimated to be around 31,000 to 32,000 crores per month. That means every month millions of Indians automatically invest money into mutual funds, regardless of the wars, panic, elections, crude oil, or American markets. This creates a constant flow of buying power. This is a historical change from old Indian market to new Indian market. Earlier, FIIs controlled Dalal Street. If foreign investors sold, markets would crumble, markets would be crashed instantly. India depended heavily on foreign capital, but the new Indian market is different now. Domestic money is becoming stronger. SIP flows are stabilizing the markets. Indian households are becoming the backbone of Indian equity market. This is called financial democratization. Domestic institutional ownership is reaching the record highs. Some reports show that DIIs now own more Indian equities than FIIs in major indices. That would have been sounded impossible 15 years ago. Now it is possible. Why these FIIs are selling in India now? Because US bonds are now attractive. Global funds now get safer returns in America itself and a strong dollar. India is looking expensive. Many FIIs believe that Indian valuations are too high than China and other Asian markets, and geopolitical tensions, wars, and uncertainty push investors toward US Treasury bonds, dollars, and gold. Emerging markets are becoming risky during the global fear. But here is the biggest difference: FIs are looking for fast money. They move very quickly, enter very fast, and exit very fast. They chase global opportunities. But here is the biggest difference: FIs look for fast money. They move very quickly, enter very fast, and exit very fast. Chase global opportunities. But our DIIs wait patiently. They invest steadily, think long term, receive continuous SIP inflows. That creates stability. The structural shift. This may be most important transformation in Indian market history. For decades, Wall Street controlled Dalal Street, but now the Indian middle class savings are becoming more powerful than foreign capital. Retail investors are changing everything. Post COVID, India saw explosive demat account growth, smartphone investment boom, UPI adoption, discount brokers, financial awareness explosion. Millions of first time investors entered the market. Platforms like Zerodha, Groww or Angel One made investment accessible to ordinary Indians. The data shows a massive power shift. FIIs selling aggressively, reducing the ownership, becoming cautious, but DIIs buying aggressively, increasing the ownership, stabilizing the markets. That is why the market bends but doesn't break completely. But there is a warning: India is stronger than before, but FIIs still matter enormously. They influence the market sentiment, rupee stability, derivatives, global perception. If global panic intensifies, Indian markets still can correct sharply. So this is not invisibility. The Indian stock market is witnessing a silent revolution. Foreign giants are selling India, but Indian households are buying India back. For the first time in the history, Dalal Street may no longer depend entirely on Wall Street. The real question is this the beginning of India's financial independence, or just the calm before the major bigger storm?